Hi, this is Gary. In this video we're going to take a look at how a bear spread works conceptually. Now what a bear spread is designed to do is designed to make money when the underlying asset or the underlying stock drops in value. Conceptually what this looks like is we are going to go long a put option at a high strike price or at the higher of the two strike prices, and we are going to offset that position with a short put position at a lower strike price, or the lower of the two strike prices. So we have a long put option at a high strike price and a short put option at a low strike price. And characteristically we have limited upside and limited downside. Now I'm going to use an example here, and I'm going to use Yahoo stock. It was currently at $23.39 when this was made on April 3rd of 2013. We are going to be taking a look at the May 2013 options here. So I'm going to give an example here how we could do that. We could, for example, we could buy the 25 puts, or buy a 25 put for $197, because we have to pay what the ask when we buy, and we're going to sell another put, and we're selling at the bid, so we're selling a 22 put, a May 2013 22 put strike price, and we're going to sell that at 38 cents. So we've got a buy and a sell transaction here, and we're going to try to make money off the spread. Now let's take a look at how this looks on a graph here. Remember, we are paying $197 and $197 because the call option is 100 shares, so think of the 197 times 100, and then we are receiving $38 or 38 cents times 100 shares. And the difference between that means that we are paying a $159 net cash outlay. So that is how much we've spent so far. Now the next part we're going to take a look at is how much cash we're going to receive at expiration. And to graph that, we need to look at a few points. The first point is the May 25 put. And in that case, if the stock price is above 25, we're going to receive nothing, because we don't have any liabilities there. Now conversely, if the stock is at 22 or lower, the most we can receive is $300. And that $300 comes from the difference between the 25 put and the 22 put, and then times 100 shares. So the maximum we can make is the 3 times 100, which is $300. So we know the maximum we can receive is 300, and we'll graph that up to the 22 location, or 22 point. Now we also know the minimum that we can receive is 0, and that's if the stock is at 25 or higher. And then we just take a line and we connect the two together, and that is how we graph the cash received at expiration. Now the next part we have to figure out is what our net profit is. And essentially we have a $159 cash outlay, and I'm going to put negative 159 down there, and we have to subtract that from the cash received at expiration to make our graph. And essentially if we go down 159, our graph looks like this. And the red is the amount of our net profit or net loss for how we will do in this situation. And just to give an example here, the maximum amount we can profit is $141, and that is if the stock is at 22 or lower in May, and that is due to the with $300 is the maximum cash we can receive, and then we subtract the $159 cash outlay. 300 minus 159 is 141. Now the maximum amount we can lose is 159, and that is if the stock is at 25 or higher, and the 159 is our net cash outlay that we spent to put this transaction in place, for example. Now keep in mind that this does not include brokerage costs, and also when someone uses a strategy like this, they typically don't do it in one put. They might do 10 puts or 20 puts or 100 puts, so that would actually minimize the brokerage cost. But if you were doing one, the brokerage cost would actually make the max loss higher and the max profit lower in that situation. And that is conceptually how a bear spread works. Thank you for watching.